Hello guys, how are you? This video is the continuation of the last session in which we discussed the working capital ratios. Now we are discussing the next category of financial ratios, that is liquidity ratios. Before discussing liquidity ratios, let's discuss what is liquidity. Liquidity means having cash or access to cash readily available to meet obligations to make payments. For the purpose of financial ratio analysis, liquidity is measured on the assumption that the only sources of cash available are cash in hand or in the bank, plus current assets that will soon be converted into cash during the normal cycle of trade. It is also assumed that the only immediate payment obligations faced by the entity are its current liabilities. Now let's discuss different ratios and liquidity ratios. Current ratio. The current ratio is the ratio of current assets to current liabilities. Current ratio is equal to current assets upon current liabilities. The amount of current assets and current liabilities in the statement of financial position at the end of the year may be used. It is not necessarily to use average values for the year. It is sometimes suggested that there is an ideal current ratio of 2 times, that is 2:1. However, this is not necessarily true, and in some industries, much lower current ratios are normal. It is important to assess the liquidity ratios by considering changes in the ratios over time, the liquidity ratios of other companies in the same period, and the industry average ratios. Liquidity should be monitored by looking at changes in the ratio over time. Now let's discuss the second ratio, quick ratio or asset test ratio. The quick ratio or asset test ratio is the ratio of current assets excluding inventories to current liabilities. Inventory is excluded from current assets on the assumption that it is not a very liquid item. Current ratio asset test ratio is equal to current assets minus inventories upon current liabilities. The amount of current assets and the current liabilities in the statement of financial position at the end of the year may be used. This ratio is a better measurement of liquidity than the current ratio when inventory turnover times are very slow and the inventory is not a liquid asset. It is sometimes suggested that there is an ideal quick ratio of 1 time, means 1:1. However, this is not necessarily true, and in some industries, much lower quick ratios are normal. As indicated earlier, it is important to assess the liquidity by looking at changes in the ratio over time and comparison with other companies and the industry norms. This ends our discussion regarding liquidity ratios. Let's move on towards debt ratios. Debt ratios are used to assess whether the total debts of the company are within control and are not excessive. Within that ratios, the first one is gearing ratio or leverage. Gearing, also called leverage, measures the total long-term debt of a company as a percentage of either the equity capital in the company, also called debt to equity ratio, or the total capital of the company, also known as gearing ratio. Debt to equity ratio. Debt to equity ratio is equal to long-term debt upon share capital plus reserves. Gearing ratio. Gearing ratio is equal to long-term debt upon share capital plus reserves plus long-term debt. It is usually appropriate to use the figures from the statement of financial position at the end of the year. However, a gearing ratio can also be calculated from average values for the year. When there are preference shares, it is usual to include the preference shares within the debt capital. A company is said to be highly geared or highly leveraged when its debt capital exceeds its share capital and reserves. This means that the company is highly geared when the gearing ratio is above either 50% or 100%. depending on which method is used to calculate the ratio, either the debt to equity or the gearing ratio. A company is said to be low geared when the amount of its debt capital is less than its share capital and reserves. This means that the company is low geared when the gearing ratio is less than either 50% or 100%, depending on which method is used to calculate the ratio. A high level of gearing may indicate the following: the entity has high level of debt, which means that it might be difficult for the entity to borrow more funds when it needs to raise new capital. High gearing can indicate a risk that the entity will be unable to meet its payment obligations to lenders when these obligations are due for payment. The gearing ratio can be used to monitor changes in the amount of debt of the company over time. It can also be used to make comparisons with the gearing levels of other similar companies to judge whether the company has too much debt or perhaps too little in its capital structure. Let's move on to the next ratio, interest cover ratio. Interest cover ratio is equal to profit before interest and tax upon interest charges in the year. Profit before interest and taxation is calculated by adding the interest charges for the year to the figure for profit before taxation. An interest cover ratio of less than 3 times is considered very low, suggesting that the company could be at risk for too much debt in relation to the amount of profits it's earning. Now, this ends our discussion related to debt ratios and liquidity ratios. Now, if you need further clarifications in any of the ratios we discussed, you can subscribe our channel. You can actually comment on it, and we'll provide a further guidance video regarding as per your needs. Thank you. In the next session, we'll be discussing the investor based ratios. That would be the last category of ratios, and financial ratios will actually end. Okay, thank you.